But yeah, thank you for joining us today. I do have some topics I want to talk about in special. So I will share my. There we go. So we're going to be looking at the OPEC plus as well as the oil market overview. So just going through this in the first topic. Second topic would be German industrial struggles, and then USD JPY and Euro-Dollar. As always, guys, feel free to ask questions. Before we go any further, what I want to do first is go through the risk disclaimer. I'm going to give a minute to everyone to read, and then we're going to start from there. Now, the first topic I want to talk about is the OPEC. All right. So let's start with the oil market. So as we all know, the oil market is it's a vital indicator of the global economic health. Okay. Let me put oil here. There you go. Let's go for the Brent. Just zoom out from it. Perfect. So on December 5th, OPEC Plus announced that they will extend the voluntary supply cuts of 2.2 million barrels per day into next year. All right. So not only that, but they plan to reintroduce the supply at a lower pace as well. So this will definitely stretch the timeline over the 18 months instead of 12 months. And basically, this means the full return of supply won't happen until September 2026. Okay. So that's, it's a very cautious approach. Disappointed the markets, right? So it's a very, very disappointing for investors. With ICE Brent crude, they fall by 0.3% on the day. So on Friday, if I'm not wrong. Thursday. And then, it was trading above $72 per barrel. And now it's trading at, and then it dropped all the way to, let me just zoom in here. It was trading above 72, so 73, $74 pretty much. And now it dropped to $71.05 at the moment. Okay. That's a 4-hour chart. And however, I was reading some analysis from ING, and now they're expecting the Brent price to average $71 per barrel in 2025. Up slightly from what they were forecasting of $69. So still pretty good. Oil is a commodity, as everyone knows. We know the big exporters. So there is definitely some volatility. We can take some advantage to try to get some profits from there. But it's I believe that majority of the trades done on oil could be from geopolitical instabilities. Okay, so basically, what does this tell us is the move that OPEC Plus did narrows the expected surplus in 2025, but it doesn't completely eliminate it. All right, so the surplus coupled with the disappointing demand growth, particularly from China, all right, it means that OPEC Plus is trying to support prices in a challenging environment. And the long-term implication, that's what we have to ask ourselves, okay? So what could happen for the whole, long-term into into oil prices? So the long-term OPEC Plus faces, they're facing some growing competition from non-OPEC producers. And the energy transition towards electric vehicles is somewhat curbing demand structurally. So for for investors and like traders as us, it pretty much underscores the importance of tracking the not only production but also the geopolitical and the technological trends that influence the energy markets. And as I just said previously, right, I think the way to be trading Brent and oil, whatever WTI, whatever you want to call it, I think the best way to be trading those commodities is through geopolitical. Okay, so that's my take. Right, I think that's how we should be looking to trade. Okay. By the way, does anyone here um, trade Brent or WTI? Just curious, to be honest. We had some forecasts from ING, as I was saying before. They were forecasting for 2025 $69. So still, a fair bit to drop below this area. Yeah. So, we had a slightly upward projection, but they were looking to project the oil prices median to be at $69. So there was another big drop here to come. But I don't think we can possibly, maybe we can touch that $69, but not that we're going to be looking to trade below that for a long, long time. Most likely what we can possibly do is continue to trade on a somewhat consolidation in this area. We had this huge breakout to the top and then come back, but same area for a long, long time, $70.60. And now trading at 71.60, 58 cents. So 58 cents. So I do believe that we can possibly continue to look at geopolitical tensions to intervene on oil prices. Okay. Now, I think one of the things I want to talk today as well is about German industrial struggles. I think I have German as a very industrial powerhouse, in my opinion. It's where, all of the big deals, all of the majority of the flow, the revenue from eurozone gets coming from eurozone, from German. And as we all know, Volkswagen, BMW, all of the German cars that get producing there. So it's a really good manufacturing PMI. It's supposed to at least have a pretty good manufacturing PMI. But it's facing some significant challenges at the moment. So in October, the industrial production fell by 1% month on month. So it's not yearly, it's a month of month. So basically they were producing let's say 1.5%, and now they're only producing 0.5%. So it's a big fall. It comes down to a sharp of 2.5% decline in September. And if we annualize that, it's the production is down nearly 5%. So it's really, really bad for German. And of course, not only for German, but as I say, German is a big country, takes a big chunk of Eurozone economy, same as France, Paris, Spain, etc. But that this can definitely change some sort of things on Eurozone. It's a very weak start to the fourth quarter. For the first quarter next year, sorry. Increasing this will increase fears of the potential winter recession as well for next year. We are not that bad as we were on last 2022 to 2023. Okay, because if we look to the 2022, and just go into trading view here because we don't have that quote. Just a second. TFM. There we go. Natural gas prices, and gas base load futures. So if we look at to 22, there we go. October to December 2022, we had a huge uptick in into the TFM prices, we were trading around $335 euros. Sorry, how much dollars are they? USD. So that's a lot. So we were trading around pretty much 400 US dollars for kilowatt. So that's no one can support these, especially on winter when winter on German gets really, really cold and snowing and etc. So I think the reason why we had such a weaker euro on that time is because of this. Because if we place a new price scale here, we can see that it was strongly related, with this uptick here on TFM, the Dutch TTF gas base load futures, was really, really intrinsic to euro dollar. All right, so euro was very weak, as well as US dollar was strong on that period, but euro was really weak because of the gas prices. So, and then it came up to be not that cold winter. All right, so people was still going onto the beach and everywhere around, and it wasn't that cold. So then the prices dropped, and now we're trading at $47. But normality of the price, if we zoom out, okay, has been around. Let me just do from the top to the bottom. Has been around somewhere $36. All right, so that's the average trading price for the Dutch gas. All right, so of course we had all of the Russia things going on with the gas and etc. But this year won't happen that, and we are coming close to winter. The gas is not that expensive as well, so we may have some sort of pullback on euro dollar. Okay, I'm going to be talking about that later. Of course, my bias is still very bearish for euro, but there is maybe a potential to be bullish for the first quarter. We're gonna get there in a second. So, as I say, for context, German industrial output remains over the 10% below the pre-pandemic level. So with this sharp of 2.5 decline in September, give us an annual basis of production is down nearly 5%. With that 5%, we still already down 10% from below pre-pandemic levels. Okay, so maybe it could be the pandemic still giving some effect, but I'm not too sure. We could say that. Anyway, so what's behind this slump is it's not just a cyclical, but as well is a structural problem. So German traditional strengths is its cheap energy and very accessible export markets. It have been undermined, and the inventory levels are at record highs, and the capacity utilization is at the lowest since 2020. Of course, except the industry like food and apparel. But when we have, I like to treat the country as a business. What's the revenue bringing? What's the EBITDA and etc. So basically, we have the 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 inventory levels really high. So basically, not getting good sales, not getting good PMIs for service. And the utilization is at the lowest since 2020. So we're already 5 years. We're going to 5 years already on, as I say, pre-pandemic is still 10% below pre-pandemic still level. So there's a lot of that could possibly happen on Europe because of this. So maybe we have an emerging trend for a very weak euro scenario for 2025. Okay. On top of that as well, we have German facing external pressure. So the United States protectionist policies and the political instability in France, its second large export partner, it's deeming the outlook for bringing some sort of business to them. Okay. So looking ahead, while there's some hope, I would say, of cyclical rebound, the problem is actually on structural challenges. So, for the eurozone, the struggles could come to the central bank, to the European Central Bank policy, and possibly leading to further rate cuts in the near term to try to stimulate the economy. So it's a very, as I say today on my YouTube video, if you haven't watched yet, let me send the link on the chat. There you go. It's on the chat. So you guys can watch that video. But as I say on the YouTube video, majority of the countries have been cutting interest rates, right? Euro, FMC, the Fed, BOC, and BOE, etc. And RBA didn't. So very interesting how they're going with that. Anyways, as I say, while there is some hope, I think with the ECB continue to cut the interest rates, with the reason why the ECB is trying to cut the rates is not because the inflation has been going down, not only because of that, but as well to try to further stimulate the consumption. Okay, and this will make them struggle even more. So my opinion is continue to be bearish on euro by next year. Now, let's talk about some currency here. So let's talk about USD JPY. I think there is a really interesting trade to be done in there, as well as euro dollar. Now, so USD JPY has been in focus, at least for me, after the Bank of Japan comments, and especially now in December. The recent US non-farm payrolls data showed a very, very solid report of 227,000 from the expected 200,000, and they revised up the 12,000 to 36,000 previously, right? So, they added 27,000 more than what they were expecting. Slightly increase in the unemployment rate to 4.2%. But still, it's on what the Fed was predicting. If you guys remember, I've done a webinar long time ago. I think it was October or November. I can't remember. Anyways, I've talked about there is a potential to us to see unemployment rate at 4.2%. It's a very, very big potential to us, and here we are at 4.2%. The Fed did predict this already. That was the band. And we can potentially go even further to 4.3%. I'm not too sure about it. Maybe we could continue to maintain at 4.2% for the first quarter next year, but there is always a potential for us to go to 4.3, okay, especially on these market conditions. So while this is reinforcing the resilience of the US labor market, it's not enough to basically tell the Federal Reserve to stop cutting the rates at its next meeting in the 18th of December. Because if we look to the CME, I've done a blog today talking about that. Let me send the link to everyone as well. Oh, sorry, it's not here yet. They didn't publish it. Interesting. Okay. Anyways, sorry for that. Yeah, so I've talked about basically the German being looking to weaken. I have the file here. Let me open the file now. Okay, so I've talked about the CME. So basically, the Federal Reserve dilemma. It's cutting with caution. The Federal Reserve focus has shifted from aggressive tightening to measured easing as it seeks to strike a balance between fostering economic growth and maintaining price stability. Market expectations indicate a high likelihood of a 25 basis points rate cut during the upcoming December meeting on the 18th of December, which would mark the continuation of Fed's gradual shift towards a more neutral monetary stance. Okay, and here we are with the CME Fed watch tool. The current rate is at 4.5 to 4.75, and we are 90%, well, 85 89.5% of the market is expecting a 25 base points cut from the Fed on the 18th of December. And from there, the 29th of January, 70.9% of the market is expecting a pause from the Fed, okay? And then on the 19th of March, they're expecting a 25 base points cut. So I think for the first quarter, we may have only one cut because the Fed only have meetings on January and March. We don't have on February. So if January is still going as it is, 70.9% of people are expecting no changes. Most likely one cut on March, and then this is it. But as we go on the 18th of December, 89.5% of people are expecting a 25 base points cut. Okay, so really interesting how markets are moving. As I say, at the same time, the labor market, the unemployment rate, everything else, it's not enough to stop the Fed to continue to cut rates from the next quarter, as well as this next meeting in the 18th. So at the same time, we have the Bank of Japan trying to finally balance the decision on whether to hike the rates or stop. The speculation is very high, but we do have some mixed signals from Governor Ueda, and he have kept market in some sort of guessing, right? They don't want to give us, of course, they don't want to give us what is going to happen, but there is always that guess probability, right? If the board hikes, we could see strengthening of the yen, of course. But however, the USD JPY most likely will remain sensitive to US economic data as well as the central bank moves. Okay, if we look to USD JPY right now, let me just check this out. We've had all of these move down from 162 down to 140, 139, 600, from then to 156, 57 pretty much, and then down to 148. So this move here, this whole move here was basically done because of Governor Ueda giving some hints that he will hike monetary policy. And then he comes and say, well, maybe we won't, as always they do. And then the market finds itself on a guessing sort of period. So then the NFP comes up and we have a stronger USD going higher, USD JPY. So yes, I do believe we may have some sort of forward. I think we may break this up the stop here if the Japanese yen continue to be weaker. Of course, it will depend from the Bank of Japan, but it's showing some resilience on USD side. Any questions before we move to the next topic? No question, guys? Wow, no one is asking questions now. Interesting. Okay. Well, let's move to next currency pair, euro-dollar. I don't think Satish says, I don't think Bank of Japan will hike because of latest bankruptcy. That's really interesting that you think that. Do you think that the Bank of Japan won't hike? Oh, do you think that Japan will hike? Don't think. Okay, right, higher. Okay, so basically because of the Bank of Japan bankruptcy or other banks? Because I don't think that makes sense in my opinion. I'm not saying that they will. Okay, I do believe that they won't as well. But what they do Bank of Japan is really tricky because what they try to do is they always try to manipulate the currency through forward guidance. Okay. They come to the media, they say something, and then they stop. They pretty much don't do that. Okay. So yeah, my thinking is that they want hike, but not because of the bankruptcy. It's just because I don't think the inflation is still high enough for them to do that. Aditya says most dovish policymakers of Bank of Japan is also hinting a rate hike. Yeah, but that's exactly what I say, right? They try to control the currency through forward guidance. So this is why I don't take any data from Japan, right? I just try to actually predict if they're going to hike or not through the inflation. All right, so euro dollar, very, very resilient. It has been going around here since 18 of last month. So there's pretty much a month. Another week we will be trading on this range for a month. Okay. So the euro has been proving itself very resilient despite the economic and political challenges. We saw. Sorry, guys. We saw euro dollar hitting a very, very low point right here at 103,363. I think it was 335, not 63, but anyways, in November. And now rebounded above to 106 and then down back to 105,600. So 800, sorry. The recovery comes as the ECB signals further rate cuts, but stays clear of drastic measures. So maybe they could do a 50 base points cut. I'm not too sure if they would do this for this month. Okay. We can check. Oh my God. We can check on the overnight swap rate. Let me just bring it here to everyone. There we go. So we have a 84% probability to cut by 25%, 25 base points, okay, on the 12th. So in 2 days, we're going to be having the ECB. So I don't think they would do a 50 base points cut. But the market has been pricing, if we have a 50 base points cut, euro would be stronger, not weaker. Okay, it would be better for euro because it would so basically the rhetoric of the ECB right now is to stimulate consumption. All right, so they're trying to fulfill consumers with cheap money, and for that they need to cut the interest rates. And if they cut further, if they cut a big amount, let's say a 50 base points, then it would be really good for the economy because it would continue to fulfill the consumption from other people. Okay. Now, if they do a 25, then maybe not that good. Okay. So I just think at this moment it's the opposite. What's notable here as well is that despite political turmoil, despite the political presence in France, we haven't seen significant contagion to the eurozone economies. This limited this spillover has somewhat helped to stabilize the euro for now. Oh, someone drew on my screen. Let me take this off just a sec. Done. So this has done some sort of stabilization on euro that we can probably continue to see this very stable. Okay. Now, it's worth noting that seasonal forecasts, seasonal factors, often cited as the reasons for the currency movements, are not statistically significant anymore. Instead, the market sentiment, the data releases, the geopolitical developments, they're playing a much more decisive roles at this stage of the market. Okay. So basically, what I think can possibly happen to euro-dollar is, yes, some sort of pullback. I don't think this is very good pullback. I think we can expect something else, maybe somewhere around here. But if the Bank of Europe do, the ECB, the European Central Bank, do a 25, maybe we can go to lower. So not that good, to be honest. Is it someone wants to talk? No? Okay. Right. So basically, that's what I'm expecting from euro dollar. Okay. So USD JPY to go up, euro dollar to potentially go up, but then continue to go lower next year. Okay. Maybe parity. Yeah, maybe parity. We can come to parity 1-on right here. But not now, but not like that. Okay. Let's see how the ECB will be. Aditya says, hey, Luca, do you think ECB will be dovish? And then Satish says, but Bank of Japan nowadays for the news channels. Well, so let's go Satish first. So Bank of Japan nowadays hinting before the meeting through the news channels. Well, that's exactly what I'm saying. They always try to forward manipulate the currency. So they try to communicate something and then they do the opposite. So be very careful with that, because Bank of Japan, they're very tricky. Okay. Aditya, hey, Luca, do you think ECB will be dovish and are you short on euro dollar? Well, am I short on euro dollar? My personal take, all right, this is not a financial device, is that yes, I'm short on euro dollar. Not now. I've took profit of majority of my positions, but maybe when we get a pullback, then why not? It seems very promising trade, in my opinion. Okay. We try to minimize the risks through waiting for a pullback, but I wouldn't mind to be into the market at the moment as well. Okay, so that's my take on euro dollar. Now, do you think ECB will be dovish? I don't think ECB will be dovish. I think they will somewhat neutral to dovish, but not completely dovish. Because if they be completely dovish, then euro would be devastated. With the stronger US dollar, wouldn't be any good. Okay. Now, so to wrap up, basically we've explored the cautions approach by the OPEC plus, the German industry struggles, as well as the implication for the eurozone, the dynamic trends that are going on with the currency markets, and all of these factors are highlighting how interconnected the global economy is, and how multiple forces from structural shifts to central bank policies, they shape some market movements. I don't know. Satish says nowadays we're not updating your trade ideas on Finland's or else taking any trade. No, I haven't taken any trade, but I'm very busy with some other projects, with building some other strategies. So I'm not very activated on FinLogic's, but I plan to come back, and I will let you guys know. So yeah, guys, thank you so much. I think this week there is plenty of opportunities for us. Watch the market, US dollar, euro, pound as well. There is definitely some good trades on there. Thank you for all. Hopefully I can see everyone back tomorrow and we can catch some good trades. Have a good week ahead, and I'll see you guys tomorrow or in the next video. Thanks, guys. See you. Bye-bye.